Joining me today is Oliver Dachsel from Aris Mining. Oliver, thanks so much for joining us.
Thank you for having me.
So, Oliver, it's the first time we've chatted with Aris Mining. Can you give us a high-level overview of the company?
Sure. So we're a Canadian company incorporated in British Columbia, headquartered in Vancouver, listed on the TSX and the NYSE American, have a market cap slightly north of 700 million US today. And we're operating 2 mines in Colombia. Those 2 mines, Segovia and Marmato, produced 226,000 ounces of gold last year and generated adjusted EBITDA of about $150 million. And we are right now in a transformational growth period by way of brownfield expansions, fully permitted, fully funded, that will take us from 226,000 ounces last year to a run rate production of about 500,000 ounces in the second half of 2026. So it's transformational near-term growth. And in addition to that, we have longer-term growth options by way of Soto Norte and Toro, Peru. In Soto Norte, we have a 51% interest, and our joint venture partner there is Mubadala, the sovereign wealth fund out of Abu Dhabi. And in our view, this is one of the best undeveloped underground gold development projects in Latin America. It has a resource of 8.5 million ounces on an indicated basis and a resource grade of 5.5 grams per ton, right? And I think that brings me to another important point. The resource endowment that this company has is tremendous. We have 20.1 million ounces of measured indicated resources across all of our properties and an incremental 9.1 million ounces in inferred. And I mean, that in itself is, I think, a significant differentiator of the company. But what's also important to highlight is the high-grade nature of some of our deposits. So Segovia is actually the second highest grade gold mine in the world, having a reserve grade of 11.6 grams per ton. And Soto Norte, as I said, has a resource grade of 5.5 grams per ton. So pretty outstanding metrics.
Yeah, absolutely. Now, I do notice that you guys are still sort of negative cash flow despite having produced quite a bit of ounces last year, 226,000 ounces. What needs to happen for the economics to turn?
Well, so we're negative cash flow because we're investing heavily into our assets, right? So at Segovia, we are actually cash flow positive. Last year generated $66 million of free cash flow after tax, after growth capital, and that was in a very different gold price environment, right? The average realized gold price at Segovia last year was $1,933 per ounce. But you know, like we invested a lot in Segovia and in Marmato, and so you know, it's going to be for the remainder of this year and most part of 2026 a story of reinvesting what we generate into our projects, right, to get us to that 500,000 ounce run rate. But to maybe kind of give you some idea for the cash generation potential, in particular of Segovia, this year we've guided for a range of 200 to 220,000 ounces at all-in sustaining costs of $1,225 to $1,325 per ounce, right? So in this market environment, an all-in sustaining cost margin of about $1,000 per ounce.
So what needs to happen to increase your production from, say, the 210,000 ounces to where you guys projected at 500,000 ounces by 2026?
Yeah. So at Segovia, it is a debottlenecking of the processing plant. Today, we have a throughput capacity of 2,000 tons per day, and we're taking that up to 3,000 tons per day. And the way we're doing it is removing the bottleneck, which is milling capacity. When you go to Segovia, what you will see is that we're operating in a pretty confined space, given that the processing plant is built in a narrow valley, right? So what we're doing is we're moving the receiving facility where we take in the ore from our contract mining partners, move that to a new location, and then use that space to install a second ball mill. And those two are the key modules of the expansion. right? And that in total should cost us about $11 million in expansion capex. So incredibly attractive project when you think about it from a capital intensity and return on invested capital vantage point, right? And that project we expect to deliver towards the end of, actually at the beginning of next year. And then we're going to ramp it up over a 6-month period so that we should get to that 300,000 ounce run rate level by the second half of 2025 for Segovia. With regards to Marmato, it's a different story. Today, Marmato is a marginal asset in our portfolio, produces 25,000 ounces at very high all-in sustaining costs, so high that even in this gold price environment, it is barely cash flow break even, right? But what we're doing is we're building the lower mine there, and that targets a different mineralization, a porphyry-style mineralization, as opposed to like the narrow vein structures that we have at the upper mine. And once the lower mine is in operation, we will be handing over the upper mine to contract mining partners, very similar to what we're doing at Segovia. And that in turn will put us in a position to produce close to 200,000 ounces of gold at Marmato on a go-forward basis. The capex budget there is $280 million. And we expect to deliver that project in terms of first gold pour towards the end of 2025, and then ramp it up over a 6-month period. So, sorry, one more thing on that. 122 million of the 280 is going to get funded by way of a stream with Wheaton. And that is subject to construction milestones like 25, 50, and 75% of project completion measured by capex spend.
Well, Oliver, thanks very much for hopping on here today. Aris is certainly a very interesting company in that you guys are a gold producer that still has quite a bit of torque in it with some pretty high grades. So I really appreciate you taking the time to do this, and hopefully we can have you guys back on in the future to tell us more about that ramp up.
Thank you for having me, and thank you for your interest.